Hi everyone, welcome back to Top Trader Cairo. Today's video is an important one. It's already November, and what you're about to hear could decide whether you make real money this month, or even in this entire market cycle. Earnings season is halfway through. I've been staring at charts, digging through numbers, and something jumped out at me. There are three companies the market has completely overlooked. On the surface, they look messy: valuation swings, negative headlines, analysts trashing them every week. But I went line by line through their earnings, their products, and their long-term plans, and I came to one simple conclusion: these companies are all undervalued. And the reason is simple: all three are marching toward deep integration with AI. If their roadmap plays out, the next decade offers at least a 10 times runway. Today's video isn't brief, but every part of it comes from repeated modeling and deeper thinking on what the future could look like. Stick with me until the end, because real opportunities usually hide in the places nobody is looking. While earnings season is still open, I want to show you the three most controversial names among the so-called Magnificent Seven. Companies everyone thinks are struggling but might actually be the first to bounce back. On the surface, they look problematic. Underneath, the upside is massive. Let's start with the first one, Tesla. Among the seven giants, Tesla is easily the most dramatic. The stock ran from the low hundreds to over 400, then crashed back down, but the attention never went away. But have you noticed something? Tesla has been strangely quiet lately, and that silence is exactly what worries me, in a good way. Usually, when Tesla gets quiet, a major inflection point is forming. This time, almost nobody seems to realize just how important this moment is. Right now is the window that decides whether you catch the next wave or sit on the sidelines for years. Let's pull out the biggest highlights from the latest earnings report. This quarter, Tesla posted $28.1 billion in revenue, up 12% year over year and 24% quarter over quarter, beating expectations by a wide margin. Two segments carried the quarter: vehicles and energy. Vehicle revenue hit $21.2 billion with nearly 500,000 deliveries, another all-time high. Why did the auto business perform this well? Two main reasons. First, China demand for the Model YL is so strong that whatever they produce basically gets sold immediately. Second, US subsidies. The EV credit under the IRA was set to expire at the end of Q3, so it triggered a mini-buying frenzy. But the metric investors really care about is margin. This quarter's gross margin came in at 14.7%, climbing for the second straight quarter. That means the price cut strategy is stabilizing instead of spiraling. And then there's the energy business. Revenue reached $3.4 billion, up 44% year over year. Extremely steady. But the wildest number is free cash flow. Tesla generated $4 billion in free cash flow, almost triple what Wall Street expected, and the highest in its history. For a company ramping up AI investment and quietly preparing for potential acquisitions, this cash cushion matters a lot. The more cash Tesla piles up, the more confidence the market will have in everything it's building. Now, most people hear numbers like this and think, great earnings, stocks going up. But smart investors know Tesla's price has never been about financials alone. Two storylines drive the long-term trajectory. One is fundamentals: revenue, profit, cash flow, deliveries. The other is the tech narrative: SSD, Robotaxi, humanoid robots. The fundamentals keep the stock grounded. The tech narrative decides the ceiling. And here's what's interesting: Tesla's story arc is quietly shifting gears. So where does Tesla's real long-term value come from? It's simple. The tech narrative sets the ceiling. The fundamentals just support the base. The reason the stock hasn't exploded yet is because the tech catalysts aren't fully unlocked. Elon has basically placed all the big bets on a single time marker: 2026. Yes, 2026 is when Tesla enters true breakout mode. Three major tech pillars converge in 2026. The first is FSD V15, the version many believe will bring Tesla close to full autonomy. This is the jump from usable to genuinely good. Once that experience clicks, analysts will have no choice but to rewrite the valuation model. The second is Robotaxi. Austin is already operating no driver rides within a growing geofence, now 3 times larger than its original zone. They've logged more than 250,000 fully driverless miles, and controlled tests in the Bay Area have exceeded 1 million miles. Right now, scale doesn't matter. What matters is proving the system works safely from 0 to 1. Say that's proven. Scaling from 1 to 100 becomes a timing issue, not a technological one. And once this business model is validated, it turns into a pure cash printing machine. The third is Optimus, the humanoid robot moving into small-scale production. And here's what surprised me. During the latest earnings call, management talked more about Optimus than about FSD or Robotaxi. This wasn't hype. This was the first time Tesla laid out a real production path. Elon even gave specific dates. In Q1 2025, they'll show Optimus V3 and begin preparing for mass production. By late 2026, the production line will be able to build 1 million units per year. In other words, humanoid robots enter real production in 2026. This isn't sci-fi. It's the roadmap Musk personally confirmed. So you might wonder, if the long-term picture looks this good, why is Tesla still so quiet in the short term? Because the near-term challenges are real. Q3's strong deliveries probably pulled some demand forward from Q4. The US subsidy phase-out is affecting momentum. The long-rumored Model 2 still isn't released. Margins are improving, but costs are still heavy. And the biggest wildcard of all, will Tesla actually acquire Xile? These moving parts freeze the stock in this strange equilibrium, neither collapsing nor rallying. But that also means the real pricing power is still in the future. And from the 5 or 6 years I've been tracking Tesla, 2026 is shaping up to be the most explosive year in its entire tech narrative. FSD, Robotaxi, and Optimus will all hit critical milestones around the same period. Those 3 storylines will merge and reshape Tesla's business model and valuation playbook from the ground up. So even though Tesla looks calm right now, under the surface, it's more like a pressure system quietly building strength, and one sudden shift could trigger a sharp breakout. The real question is, do you want to build a position while it's quiet, or do you want to chase it after it takes off and regret missing the setup? Now let's move to the second company, Meta, the most misunderstood giant in the entire group. If I had to pick one company that got beaten down unfairly, Meta would be at the top of the list. People forget this. Facebook, Instagram, and WhatsApp once made Meta the undisputed king of global digital advertising. Gross margins near 80%, net margins close to 40%. To put that in perspective, every $100 they made left $40 of pure profit for a full decade. Revenue, profit, free cash flow, users, everything climbed with 30 to 40% compound growth. A business with metrics like that should have been treated as a superstar growth stock. Then came the turning point, one word, metaverse. Zuckerberg went all in, and the whole internet roasted him for it. Burning cash, losing money, unclear use cases. Nobody understood it. The problems piled up. And the reality was simple. You can't expect regular people to strap a big VR headset on their face every day. So from 2021 to 2023, Meta's net profit and free cash flow collapsed, and the stock was literally cut in half. The former champion suddenly turned into the broken stock. But here's what almost everyone missed. Meta has already completed its reversal, and the turnaround is way cleaner than people realize. Let's break down what changed. First, its financial foundation is insanely strong and recovering fast. Before 2022, Meta basically ran with zero debt. Even now, whatever debt they carry could be erased instantly by their cash balance. Among tech giants, very few maintain books this clean. In 2023 and 2024, free cash flow and net profit snapped right back, almost returning to their pre-pandemic strength. But the real turning point wasn't financial, it was strategic. Meta didn't cling stubbornly to the metaverse. They quietly switched lanes. Second, they pivoted to smart glasses, a full bet on the next generation of personal interface devices. Reality Labs today isn't the old VR toy division everyone laughed at. It's now focused on one bet, smart glasses. Their collaboration with Ray-Ban is already on the second version. What can these glasses do? Take photos, record video, translate, interact by voice, and even connect directly to ChatGPT. Imagine a future where you don't reach for your phone, you just wear a pair of glasses, and 80 to 90% of daily information tasks happen seamlessly in your field of view. That's the future Meta is aiming at. Of course, it's a huge gamble. Reality Labs loses money every year, and the latest operating margin is literally negative 800%. Unlike Google, Meta doesn't have a bottomless profit pool to cushion the blow. The spending from Reality Labs is big enough to drag down Meta's overall earnings. This makes the business a classic high-risk, high-reward setup. If it works, it becomes the next iPhone moment. If it fails, Meta becomes the butt of the same old jokes. That's why I say Meta's risk and opportunity are basically the same thing. So how should investors actually think about this company? Let's step back and look at valuation. Wall Street overwhelmingly rates it a buy, with price targets between $770 and $1,117. Its PEG ratio is around 2, more expensive than it was earlier this year. So how do we judge it? Here's a simple framework. Worst case scenario, the smart glasses strategy flops. Even then, Meta remains a cash-printing advertising empire. It's not going anywhere, and its valuation still holds. Best case scenario, the smart glasses strategy succeeds. Then Meta becomes the company that releases the next device that redefines how humans interact with information, a breakthrough on the scale of the iPhone. This isn't a question of whether Meta survives. Meta is already safe. The real question is whether it creates another wave of explosive growth. So the entire investment thesis boils down to one sentence. Do you believe smart glasses are the next interface revolution? If you think it's unrealistic, Meta is just a steady, highly profitable ad business. If you think this is the future, then today's Meta is still not fully priced. Which side are you on? Tell me in the comments. I'm curious how you see it. The last company we're talking about today is Amazon. Mention Amazon and most people immediately think of e-commerce Prime and that massive global logistics network. And yes, those are real moats, but they're not what truly drives Amazon's long-term stock performance. What makes Amazon special is that it runs on two engines. The front end is the global e-commerce ecosystem. The back end is AWS, its cloud empire, and the real profits come from the back end. If you look at the fundamentals, Amazon has been around for 30 years. For the first 2 decades, the company barely made any profit at all. The real earnings didn't show up until the last 5 to 7 years. AWS runs with huge margins and contributes the majority of the company's profit. The e-commerce business, while massive and incredibly influential, doesn't actually generate high margins. It mainly acts as the user funnel and traffic engine. This two-engine structure creates something unique, a complete commercial ecosystem that stretches from what consumers buy to how global companies run their computing. Amazon controls the front end of consumer demand and controls the back end of enterprise computing, a moat that's both wide and deep. So you might ask, if the business is this solid, why has the stock barely moved this year? The answer is simple. It's not the fundamentals. It's because the market is starting to doubt whether AWS can stay king of the cloud. Competing platforms like Azure and Google Cloud are growing 30% or more every year. AWS is growing 17.5%, noticeably slower. So Amazon is still the leader, but if they can't lead the AI wave, the market might reprice the stock. But don't worry, Amazon isn't sitting around waiting to be overtaken. They still have several trump cards. The first is their own AI chips, Trainium and Inferentia. Most people don't realize AWS isn't relying on anyone else's hardware. They built a complete stack in-house, Trainium for training, Inferentia for inference. This lets AWS handle AI workloads cheaper, faster, and more reliably, while locking customers in, because migrating off AWS becomes extremely expensive. The second trump card is Project Kuiper, their satellite network. The whole idea is to bring AWS to every inch of the planet, meaning in the future, whether you're in a remote African village or a jungle with edge AI devices, or an autonomous vehicle sitting in the middle of a desert, if you can see the sky, you can access AWS. This opens entirely new markets: agricultural AI, remote healthcare, border monitoring. Amazon isn't just running an online store anymore. They're building the world's most widespread compute infrastructure. The third advantage is that the e-commerce business has fully recovered. During the pandemic, Amazon took a real hit: inventory issues, overwhelmed logistics, everything out of sync. But now warehouse efficiency is back, turnover is faster, global delivery times are improving again, and the entire e-commerce engine is stable. Now, let's talk valuation. Is Amazon cheap at today's price? Shares trade around $240. Wall Street's average target is around $290. Which leaves roughly 20% upside. Among the big 7 tech giants, Amazon sits in one of the more reasonably valued positions. Most analysts still rate it a buy. So why isn't anyone shouting all in? There's only one real reason: the market cap is massive, and people assume big companies can't move fast. But history says the opposite. The companies that last the longest and climb the highest are rarely the explosive meme stocks. They're companies like Amazon that inch up quietly and steadily set new highs. And if the AI era truly matures, it'll be one of the biggest winners. This sideways trading we're seeing might simply be a halftime break, which often turns out to be the best entry point. So what do you think? Is Amazon still worth adding to? Tell me in the comments. Now let's answer the question everyone wants to ask. Should you buy these 3 companies now? Let's start with Tesla. I view Tesla as a positioning play: high risk, high potential. It's suitable for slowly accumulating when the stock is in a lower zone. Short-term volatility is guaranteed, But if the tech narrative actually plays out, a 5 to 10 times return is absolutely possible. Next is Amazon. Amazon is the steady compounder. Strong defense, predictable growth, a dual-engine business e-commerce plus AWS supported by satellites, AI, and other expansions. It's extremely resilient. It's the type of stock that quietly makes new highs every year and compounds beautifully over the long run. And then there's Meta. Meta is the conviction bet. The market is still split, and the future direction is still being priced in. If you believe smart glasses will become the next computing interface, Meta has enormous upside. And even if the bet fails, their core business still generates a fortune. But if the bet hits, the valuation model gets rewritten entirely. But let me say one thing clearly. Investing is not fortune-telling. It's not about predicting a guaranteed future. It's about choosing the future that has the highest probability in an uncertain world. That's what real investing is. So today we broke down Tesla, Meta, and Amazon, 3 companies that attract the most debate. They look messy on the surface, but each one stands at the edge of a new technological wave. If they share one thing in common, it's this: the best opportunities usually appear when opinions are the most divided. Markets love simple stories, but real wealth is often buried inside complexity. These companies aren't risk-free, but their imperfections might be the very reason they hold the biggest long-term upside. So the real question is, are you ready? The new valuation cycle in US tech stocks has already begun quietly. Let me leave you with one last question. Which of these 3 companies do you believe in the most? Let me know by dropping your thoughts in the comment below. If you enjoy this kind of deep dive breakdown, remember to hit subscribe and share this video with your friends who want to better understand investing. I'll keep helping you understand a complicated market in the simplest way possible. Avoid the traps, make better decisions, and grow your wealth. I'm Cairo, and I'll see you in the next video.